Good morning. Welcome to the Eastman Financial Report. I'm Dan Eastman, your host, and today is Friday, February 27th, 2026. Thank you so much for tuning in. As always, we appreciate your viewership here at the Eastman Financial Report and throughout the day at all of the great programming you see at Worldview Tube and here on Worldview Radio. As you know, we are a Christian broadcasting network, and we've been in this space since 2006, bringing our message to the great marketplace of ideas from a Christian perspective. And what that means is we take the news and information of the day, the breaking stories, all of the excitement in the news, and we interpret and broadcast that, again, from a Christian perspective, into a very, very important and growing marketplace of ideas. This is the place where all communicators, whether it's old school mainstream media, newest podcasters, newest broadcasters, digital broadcasters. It's an ever expanding marketplace of thoughts and ideas and concepts. And here we are, and we've been doing this since 2006, and we do it from a Christian perspective. And of course, that's our ministry, it's our mission, our passion, our goal, our efforts. And you can help us in that ministry if you'd like by going to worldviewfoundation.com, of course, and making a donation. You can sign up for a one-time donation, and we truly appreciate that. Or you can sign up for monthly donations, which has the added benefit of flattening our revenue curve a bit, so we can match our costs to revenues, and we can keep our content free of charge. As you know, we don't charge a paywall or a subscription fee. When you watch Worldview Tube or listen to Worldview Radio, that's free information broadcast daily, and we can do that because we stay positive. And by you making a donation, that helps us greatly in that effort. You can go to worldviewfoundation.com, or on the bottom of the screen, it says wvwfoundation.com, takes you to the same place, or you can use the handy QR code, and that'll take your smartphone to the same place, and you can make a donation. And we really appreciate that, and appreciate you supporting this ministry, because this is an ongoing effort, and we are very proud of what we do, and we're very happy to be able to continue bringing this information out and forth from a Christian perspective. You can also help us by doing business with the vendors you see advertising throughout the day on our networks. Effectively, we don't sell blocks of advertising time. Rather, we partner with companies we know and trust. And when you do business with them, you know that we've vetted them and they're good people. But a small portion of the proceeds comes back to us in the form of a commission. And that also helps us in our revenues to keep our broadcast ministry free of charge. As you know, back in the day when the apostles were sharing the gospel 2,000 years ago, they weren't charging an admission fee, or there was no subscription. Basically, it was a message freely given, and sometimes at very expensive cost to the purveyors. But we're doing that same thing here 2,000 years later, and we will continue to do that until the second coming, of course. And we are broadcasting this ministry primarily from the help of viewers such as yourself. So if we do make a donation, or you do business with the vendors you see advertising, that really helps us out. There's a third way that you can support our efforts, our ministry, and that is to go to worldviewtube.com/vault. If you do that, we have a subscription product. There's a little paywall. And if you subscribe to the Vault, you have access to all of Brandon Howe's ministry materials. It's a wonderful collection. He's written 15 books, and those are now in digital format. He's done events and seminars, conferences, all recorded. In the Vault, it's a wonderful collection of Christian ministry. So if you're struggling to look for spiritual and improvement or stimulation, having that vault in your toolbox is a great thing to have, because it's on demand, it's available 24/7, and you'll see some wonderful Christian content that can very much be of help to you if you're struggling in life, or money issues or career issues or family issues or whatever. It's a wonderful tool to have, and it also supports this ministry. And you really, by subscribing to the Vault, you become part of this church, this Christian ministry, and it's a wonderful thing to be in and a wonderful thing to have. And keep in mind, we all know people who, like us, are struggling in life with certain issues, family issues, money issues, business issues. Giving them a gift subscription to the Vault is a wonderful thing. It's not that expensive per month to do, but it's a wonderful tool to give someone else as well as have for yourself. And because that all supports our ministry and you become part of this ministry, it's a wonderful thing. So that's how you can support our efforts. You can make a donation, or you can do business with the vendors you see advertising, or you can subscribe to the Vault, or you can do all three. And that is really greatly appreciated. Well, let's jump into the news. And of course, this is Friday. Friday, and my hypothesis has always been that if you have bad news, you bring it out on Friday because by Saturday and Sunday, everybody's minds will have moved on. And if you don't have any news, Friday becomes a quieter news day. And we're in the latter of the two, of the quieter news day. There's one story that's interesting, and I want to talk about it because it sort of contradicts the consumer price index story I was talking about yesterday. If you remember, the consumer price index came out for January, and it was a lower number. It was a 2.4% headline and 2.5% core. And I said yesterday that that means that the headline and the core is they're converging into a consensus that inflation, at least the way the Labor Department sees it and calculates it, is about 2.5% in the economy right now. And then, of course, if you think of the Federal Reserve's dual mandate to keep unemployment numbers low by keeping employment high, that's the first mandate. The second mandate of the dual mandate is to keep inflation at 2% or less, and that they do through monetary policy. If you stimulate the economy, you can make money cheaper. Lowering the rates makes money cheaper. Businesses borrow more money, and of course, they hire more people, and that puts people to work, lowering the unemployment rate. And at the same time, it stimulates the economy to create more sale of more goods and services, more dollars rotating through the system. And of course, if you do that too much, it triggers inflation. So you have to be able to stimulate the economy to keep people working, but not too much, or it'll overheat, like the kettle on the stove will overheat, and then you'll have an overheated mess because you've effectively gone too far. And that's what the Federal Reserve is charged with, finding this sweet spot in the middle. And that's what the Federal Open Market Committee does when they go into their meetings every 8 weeks to try and figure out how should they deal with the interest rates. Should they raise the interest rates to slow things down, or should they lower the interest rates to speed things up, or should they just leave it where it is because things are moving along? And the last time they met, of course, they did. They left the rates flat, the same. They didn't change the rates because they had been cutting the rates. And when they do that, you want to watch for an increase in inflation. Now, if we're cutting too much, is the economy overheating? Is inflation rearing its ugly head, as the pundits would say? And of course, we're watching these inflation numbers very carefully, and that's why it's important. So when we saw the consumer price index numbers at 2.5, basically down from December, you said, well, that's a good thing because inflation is declining within the economy. And then the question becomes, okay, if we have inflation under control, let's take a look at labor. And I talked about that yesterday. Remember, yesterday was Unemployment Thursday. And traditionally, at least in Professor Eastman's class, we would look at the unemployment claims from the prior week, which are published by the Bureau of Labor Statistics, and try to make a trend line. Remember the trend line of data points on a weekly basis over a period of time, trying to determine, are we seeing more unemployment or less unemployment in the economy? And yesterday's numbers were soft. I think it was, what was the number? It was, I have it written down here somewhere, 212,000 people applied for unemployment. Now, 212,000 people is a lot of people. And of course, we keep them in our prayers because it's a place nobody wants to be, where you're unemployed through no fault of your own, but you're going to the state for basically a welfare check to survive. But notwithstanding, that number is low, and it's on the low end of our curve. And I said when I started 3 years ago, these numbers were somewhere between 200,000 and 250,000. So for 3 years, every week, there's been a very, very stable number around the 200 to 250, and we're right in the low end of that sweet spot. So what it tells you over a 3-year period, we're not seeing a real stampede into unemployment. So what it tells us is inflation is coming down and we're not seeing unemployment going up. Now, the unemployment claims is one metric. There's more to unemployment than people who file for unemployment because many people don't file for unemployment. You lose your job. Well, you've got some credit card capacity, you're living on your credit card, or maybe you've got some savings. Imagine that, an American with savings. You might have some money to spend because you saved, or perhaps there's a dual income household and you can limp along, or you find a new job. All of those people don't show up in the unemployment claims number, but the unemployment claims number is a very interesting constant that we can estimate around, and it creates that flat trend line. So basically what I'm saying is that we don't see unemployment at this point in time as being a real serious problem. and we don't see inflation being a serious problem. There are some that would argue any inflation is a secret tax and it's eating away at your savings, and it is. There's no doubt about it, because if you 2% every year, 2%, 2%, 2%, it's cumulative. Eventually, that does erode the value of your savings. So that is not exactly utopia, but if you don't have some inflation in the economy, it's like I use the metaphor chili without chili sauce or powder in it. It's kind of a bland mix. You need a little spice in the chili to make the economy hum along. But if you put in too much spice, obviously, then that's inflation and nobody wants to eat the chili. So what we're seeing are numbers that are stable. And what does that mean from the perspective of the Federal Reserve? Now, they're going into their next session, March 17th and 18th. And of course, the only thing they debate, of substance, or at least of public interest, is the question of, are the interest rates at the right level? And that's where the Federal Open Market Activities and Committee is the monetary policy component that the Federal Reserve does. That's what Congress empowered them to do, is to fiddle around with the interest rates to stimulate the economy when it needs stimulating, and slow it down when it's too stimulated, slow it down. And somehow you basically bounce off the sides of the bumpers until you get down to the end where the bowling pins are. It's the metaphor. So that's what they're going to be looking at. And if you're a predictor or a soothsayer or a gambler, or if you like to postulate on the future, you would suspect that with a low inflation rate and with an unemployment rate that is not too troubling. It's about 4.2%. If you look at the unemployment rate itself, which again is another government estimate, you're not seeing an overheated economy, and you're not seeing an increase in unemployment. So therefore, that's a real signal to do nothing, because one of the things that Wall Street, in the investment world, and the economy, and even political types or policy types, are always a little bit concerned about volatility. If rates are going up and rates are going down, or rates are going up and rates are going down, then that creates uncertainty in markets. And when there's uncertainty, people pull back, and that tends to suppress the prices. So the Fed doesn't like to signal uncertainty, and that's why in the last go around, they basically left the interest rates the same. So, okay, well, let's just see what happens for another period of time, and then they'll go back in March. So one could speculate, I guess, that the Fed may do nothing other than just leave the interest rates the same, and that will rub right up against the White House, because the President of the United States, President Trump, is really interested in having interest rates lowered to stimulate the economy bigly, I guess, so that we can put the economy into high gear, and off it goes, and it's creating prosperity for everyone. And that, of course, can trigger inflation if not done properly. So there'll be that clash where the White House is really eager to have interest rates cut, and the Fed, my guess, my hunch is that they may be a little bit more conservative and not wanting to do anything dramatic, certainly not wanting to help the president out. So we'll see what happens, and that's to be seen. But as of 2 weeks before, I guess it's 3 weeks before the big meeting, things are looking fairly stable. Now, having said all of that, I want to talk about the news story of the day, because there is, every once in a while on a Friday, something interesting comes out, and this is that day. There is, of course, a metric that I've talked about in the past at length, and it's the Producer Price Index. We had talked about the Consumer Price Index, which is retail prices and how they're going up 2.4%, 2.5% core if you take out energy and food. That's what we, the consumers, pay. That's that market basket of goods that the government analyzes and decides, what are the price changes going on within that market basket, and that's what they produce with the Consumer Price Index. But there's also a Producer Price Index, which many would argue is probably more boring, but much more important. And basically what that does, the Producer Price Index measures the cost inputs into manufacturing companies and service companies. When you think about a company, the theory of the firm, microeconomics, you basically have revenues minus expenses, and what's left is income, and hopefully that's a positive number. And if the income is positive, divided by the capital invested, that's your earnings, your return on equity, okay? And if you divide it by the number of shares outstanding, if it's a corporation, and there's earnings per share. And that's the classic business model. It takes you 4 years in business school, and those who come out understanding that, they win. The ones But anyway, so the point is, we take a look at the theory of the firm. What is a firm? Its revenues it's an entity, land, labor, and capital. Okay. You have some land, you put some capital on it, you apply labor to it. That's a firm, that's a business. And what we want to measure is what are the cost inputs coming into those businesses, and how do those cost inputs affect the business's pricing of its goods and services? Because it's, again, revenues minus expenses is income. And if revenues are flat and expenses are going up, algebraically, income is going down, and management doesn't like to see income going down. So what they will do, if revenue is flat, they will cut costs by laying people off or finding cheaper supplies or whatever. It's the process of management. When you manage a business, you're managing the revenues that you generate, you're managing your costs, and you're managing your costs to produce a positive bottom line. If you're losing money, you're not in business. You're going out of business as soon as your capital's all eaten up. You're gone. So we take a look at the producer price index because those are cost inputs into a business, and if the price of the stuff is going up, then the business is going to have to raise their price to the consumer, and that's the CPI. The consumer price index will go up if there's cost push inflation coming up from the vendors. Now let's use a simple example of a pizza parlor. If you own a small pizza parlor in town and you're selling pizzas and everything's good, and then the price of flour goes up, and you use a lot of flour to make the dough for the pizza, well, you have to make a decision as a business owner. Do I eat the cost increase and just hope it's temporary? Can we ride it out? Can I save money by changing out the light bulbs or something? But eventually you're going to have to raise your price to stay in business, because revenues minus expenses is income, and income can't go negative. So you have to keep the bottom line in the positive, and eventually you're going to raise your price to the consumer. Well, the minute you raise your price to the consumer, that's the consumer price index. So consumers will start to feel higher prices. It's a cost push that comes up. Consumers don't know that your price of flour went up, or tomato sauce went up, or meatballs, whatever you got. They don't know that. But what they do know is you're charging more for the same 14-inch pizza than you did last week. And the reason is because my cost inputs are going up. And of course, the inputs are going up higher than our CPI. So I've got to take a break here, and then I'll come back and I'll explain the difference. Be right back. Thanks.
Hello, I'm Brandon House. Would you like to gain access to over 20 years of my radio shows, TV shows, my books? I've written 15 books, and most of those books are ebooks now. And we have conference DVDs, conferences where we filmed our conferences at the Ozarks, literally starting 20 years ago. It's all available in our archived vault. All you have to do is go to worldviewtube.com/vault, worldviewtube.com/vault, and for a reasonable monthly fee, you gain access to over 20 years of Christian worldview programming, news, information, books, documentaries, and a powerful search engine. And folks, it's a great way not only to educate yourself, equip yourself, but it's a big way that you can help fund our continuation as a broadcast network. Please check it out. worldviewtube.com/vault, worldviewtube.com/vault, and help us continue pushing out a Christian worldview.
Okay, I'm back. So I'll deliver the punchline now. With the producer price index was up, and it was up noticeably higher than the CPI, not only with respect to the delta, but in absolute numbers. The producer price index is up a half a point month over month. It was up 0.4 of a point December month over month, but right now it's driving at about 2.9% year over year, which means there's a 3% inflation rate at the producer level. And eventually that is going to put upward pressure on the sale of their goods or services, and it will reflect in the consumer price index with a higher number down the road. You don't know when. Eventually it'll work its way through the system. And this was sort of a surprise, because we've been celebrating low inflation all week long, only to watch the PPI go up, and now we're at 2.9% at the producer level, their costs inputs for the producer, and we're looking at a consumer price index of 2.4, 2.5. So there's about a half a point differential between what the producers are paying to make the stuff, the goods and services that you consume, and the prices you're paying. And eventually, if that curve doesn't flatten at the producer level, then those that pressure will cause the prices of consumer goods and services to go up. And the Fed knows this. That's why they're watching this number. And when we talk about them going into session in 3 weeks, it's not just the consumer price index or the the other index that they look at. I'm blanking on the other acronym, but the point is they will also be looking at the producer price cost inputs as well, because that has a push effect with a lag. And the lags, it's very difficult to set monetary policy because it doesn't happen instantly. When you adjust interest rates, it takes a long time. And I talk about this when they adjust at the open market meeting, they adjust the interbank lending rate, and that's the rate that banks borrow and lend to each other to make sure their reserves are in the right zone. That takes 8 to 10 to 12 months to trickle out. It's a trickle out theory. It doesn't go trickle up or trickle down. It trickles out. Federal open market activities at the desk in Manhattan, that has a daily impact. If they go in and buy bonds and push money into the market, those interest rates adjust in real time during the trading day. So there are different ways that the Fed operates. So that's why we have to look at this as the Fed is really struggling with inflation is just barely under control. Unemployment has not reared its ugly head, because anything over 5% unemployment is a political problem, and of course that triggers the dual mandate. So you're in the high end of the safe zone on unemployment, and you're sort of in the low end of the safe zone on inflation. And what that suggests in normal times is that the Fed may just leave it flat for another cycle just to see what happens. But we've been, stuck in this rut for the 3 years that I've been broadcasting this show. I mean, it's the same numbers. It's kind of hard to find exciting news when you're looking at the same numbers three years in a row. But that's how that works. I want to talk about something else in the remainder of the time that I have, and I started with this yesterday. It was talking about Fed independence, the Federal Reserve independence, and why the Federal Reserve theoretically would be independent, because it's owned and operated by the banking system, which is owned and operated by the people. It's not a federal government banking system like they have in China. This is local banks with local shareholders, and they own shares of the Federal Reserve. And who owns the Fed? Well, the shareholders of banks locally own shares in the Fed, 12 branches. So it's really owned by the Wall Street, the people who have stock, that own stock in banks. That's who owns and controls the Federal Reserve. And in theory, in a perfect world, the banking system would just regulate itself, and it would be great. And the sun would come up and the birds would sing, and it would be wonderful. But the reality is, since its inception in 1913, there's always been a federal nexus. And of course, we have the Board of Governors, 7 governors of the Federal Reserve, and they're all appointed by the President of the United States to 14-year staggered terms, and the Senate of the United States confirms them. So it's kind of a quasi-governmental mush at the top, and that's the Policy Committee. The Federal Reserve Open Market Committee is the 7 governors, always the president of the New York Fed, and then you've got 5 of the regional Feds presidents, and then they rotate around. So that's the cluster of people that make these monetary policy decisions. And that's as much power as the people gave the federal government with respect to the banking. So the traditionalists will say we want an independent Fed, and other models would say no, the president of the United States should be able to control the levers and cut the interest rates or whatever to make it's all good for the economy. Congress, of course, they can't even pass a balanced budget. They're really not. It's very disappointing. The more people you talk to, the more interactions you have on media platforms and X, you realize that throughout American history, Americans have had a very poor view of their Congress. This was supposed to be the people's voice running their own government. And even going back to the Whiskey Rebellion of the 1700s and all the way through society, all the way through American history, including 1860 to 1865, people really don't respect Congress because Congress never really respects the people. They sort of, you've taken a dictator and you spread it over 535 chairs, and they dictate in a diluted manner, but they do not respect the people of America. They spend $2.5 trillion more than the tax base can afford. That's our deficit. They have done this for decades and have racked up 38.7 trillion in national debt, which will never be paid back. It's impossible. I mean, it would take it would double the age of the United States, and we'll still be paying that debt off. So the point is, people have a really jaundiced view of Congress because they don't deliver anything of substance, and the stuff that does come out, the bills are convoluted. They always benefit the special interests. They never help the little guy. It's like we're watching this no tax on tips and no tax on overtime. Sounds like a great idea, and it is. Nobody should be paying income taxes if they make less than $500,000 a year. That's the Eastman plan, okay? But we do, and okay, it sounds great. Now we're going to exempt taxes and tips. Well, I run payrolls, and I'll tell you, my payroll processing company is just really struggling with how in the world do you implement that policy? Nobody knows. Nobody knows. So we're going to see. You have this great idea, and you pass this law, and then when you try to put it into practice, it's very convoluted. Same thing with people on Social Security won't be paying income taxes on that money. Well, if you've talked to your accountant, unless you're a very low-income, impoverished senior citizen, you'll be paying taxes on that money anyway. And that's the point. These bills come through, and they're sold through a propaganda media to the American public, and the media's job is to say whatever the talking point is, and they pass this stuff, and it's out there, and it's never what is expected. Just like Obamacare. Yeah, you won't have to change your doctor, and you're going to save $2,300 a year. It was pure baloney. It just wasn't true. None of this stuff is true. So this is the Congress that we live under. This is how we govern ourselves, and it's a shameful thing. Because if you look at your state government or your municipal government, your town board, even your church board, your synagogue board, people tend to take it seriously, and you do what's good for the community or the congregation, whatever. And, you collect money and you spend the money, you stay out of debt, you do what you promise, and basically you run an honest operation. You don't see that at the federal level. You cannot argue with a straight face that what we have in Washington, D.C. is any better than King George III. You cannot make that argument. And I'd love to hear it. I would love to hear somebody explain to me how living under King George III was worse than our American Congress. I don't see it. I'm not picking on the president. He's got to do what the law says. And when the Congress passes the law and signed into law, the president must administer. But it's the lack of ability to serve the people that the American Congress is shameful. The House of Representatives controls the purse strings of the federal government. Yeah, they borrowed $2.5 trillion last year. They're right on track to do it again this year. They're not controlling any purse strings. They probably don't even know how to spell purse strings when you think about it. In our illustrious Senate, instead of representing the states in the states' interests, that this was the idea of the founders, that the states would have representation in Washington, in the United States Senate, and the state legislature and the governor would send 2 representatives each, and they'd watch out for the interests of the states. Nobody's watching out for the interests of the states. What do you mean? Well, let's take a look in Minnesota. It was $9 billion ripped off the federal treasury. It's more now. California, allegedly $100 billion ripping off the treasury. The states don't have any power. Nobody has any power. It's a sad situation. So anyway, given that situation, we talk about the independence of the Fed, and it's a very difficult argument. You could like to see a banking system and a free economy that's self-regulating and regulating itself and keeping it away from Washington. That's why New York is here and Washington is there. It's just one big collection. So how do you split that out? Well, there's been a lot of debate about what does the future look like and how is this a sustainable model? And when you look at the $38.7 trillion in debt, it's not a sustainable model. It just keeps getting worse and worse and worse until at some point the 330 million Americans are exhausted. And we're seeing that in the American statistics. This may be a great economy on the top end, but when you take a look down Main Street, you're really beginning to understand that it is not this country is not run for the people. It is run for the special interests, and the people are just victims of this process. So I want to talk more about this next week, but I also want to talk about some alternatives to federal funding that may be available that we really should start to think about, because I think people have to take power back at their state level, and the states have to start asking questions about the federal government. Instead of assuming it's this glowing city on a hill out there, it's really not. It's in a swamp. But we have to be asking the question, are we where we need to be as a society given the dysfunction in Washington? And that's the question we have to ask. Anyway, I'm out of time for today. Please go to worldviewfoundation.com and make a donation. Keep our ministry alive and happy and healthy, and have a great weekend. And I'll talk to you next week. Take care. Bye.